Hi, I'm Douglas Mason, President and CEO of Magnum Gold Corp, MGI, and the TSX Venture Exchange. A 2015 drill program on the LH property intersected several high-grade gold intersections, including 11 meters of 20.66 grams per ton gold. Additional drill targets on the LH property have been identified by a 2018 drone airborne magnetic survey to further evaluate a pyrrhotite-enriched gold-bearing system. Please visit our website at magnumgoldcorp.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Welcome back to the show, Bob, and trust you had a great Canada Day.
Did indeed, and here we have a Friday and going into the weekend, so all is well.
Bob, good job reports in both Canada and the U.S. Canada adding 24,000 full-time jobs, the U.S. adding 224,000 jobs. Good news when perhaps people didn't expect it?
Well, I don't know. I don't follow it that closely, so I don't have a forecast on it, but hey, the boom is still on, and looking at that employment number. And the other thing is that you got good numbers in Canada when Canada's policies have been anti-business federally and in many provinces. And in the United States, you have the Trump Reformation where they're trying to reduce, bring back the concept of limited government and trying to reduce the fetters on business. And so, but they've got, I think they're getting good numbers in Europe and things like that too. So the boom is still on. But what we are interested in is when the boom is not on, and more particularly when the boom in stocks and bonds is not on. So, and as we've been saying about the stock market, usually good in the first half. You know, you can find your best in the second quarter. And what you want to do is put then measures on the move. And yeah, you've got valuations relative to wages or relative to GDP exceptionally high. You've got sentiment numbers like the number of bullish articles out there, they're high. And occasionally we've had some very good momentum numbers. So all signs of kind of a topping action. But, you know, it was 6 months ago, and remember dismal December. And it was December 26th when our technical work got the sequential buy on the S&P and on crude oil at the same time. And then we had been looking for lows in December, January, mainly because of the seasonality in crude, and it got oversold enough, and we've had some good rallies out of it, which have been tied to some good rallies in the stock market. Plus, as you mentioned with the employment numbers, still very good employment numbers. So what one wants to do now is, as I've mentioned, the high valuations and high technical readings is you want to look to see when this is likely to change. And that's our game, is to watch for change. And this is it's not just fascinating, but it's also profitable when you get the changes right.
Wasn't one of the things you told us to look out for was an inverted curve where right now your 1 year rate in the U.S. is 1.86%, the 10-year 2.04%. So they haven't inverted yet, but the 5-year rate is less than the 1 year rate. And I hear something like 23 other rates have inverted. So
yeah,
is that
the portions of the curve, and that's, of course, the difference between short-term rates, like T-bill rates, and longer-term, like 10-year stuff or 20-year stuff. But there have been times when the curve has inverted, where short rates were higher than longer out. And this is a sign historically, and I think the only way I've found to explain it is that the short rate going up like the T-bill is reflecting a tremendous demand for short-term speculative money, with all of the participants out there getting leveraged up. And the telltale sign is that when the T-bill rate stops going up, and I've considered that as marking that the boom's beginning to end. And in 1929, the T-bill yield went up until May, and then in the summer turned down, and that was providing a warning that the boom was ending. And indeed, the Federal Reserve then cut its administered rate in October. So it was behind market rates. This is what I want to emphasize, Jim, is that the T-bill rate, it trades all day long, 24 hours a day, and that is determined by market forces, which from time to time, theoreticians in the Federal Reserve think that they're running the show. They're not. So that the T-bill rate, the 3-month peaked set its high in March, and it is distinctively down. Now, in the last couple of weeks, it's been going up, as part of the positiveness out there. But the curve, it doesn't have to stay inverted for very long. All it has to do is accomplish the inversion, which is due to speculation in the credit markets. Then the other one that we watch, Jim, is the credit spreads, which is the difference between high-grade bonds and low-grade bonds. And in good times, and there's often a seasonal move on this into May, June. And yeah, it was over the last, since dismal December, credit spreads narrowed. And then, about 6 or 7 weeks ago, started to reverse to widening, which is a warning. And it actually did do what we call the first breakout in working on a trend change. And then it relaxed a bit. And then now it's trying to work on what we would call the second breakout. And in 2007, we had pretty good lead on that one. I think the second breakout was accomplished in August, and the high in the market, the stock market, was the middle of October. So financial forces outside of the abilities of the Federal Reserve are changing credit markets, yield curve in a manner that is a warning, and credit spreads is given one warning and is working on possibly the second warning. So again, we look at things. Were they good in the second quarter? Yeah. Excesses reached? Yes. And when does it go bad? Usually in the fall. So let's use our term sunshine till into the second quarter, and then maybe in August turning to twilight. And I think the second breakout in credit spreads would indicate that. And then there's a possibility of people discovering bad things in the fall. That's typically when they're found. And so the curve could continue to change. Credit spreads could make the second breakout, in which case we would then have the twilight zone in the fall, the scary TV program. And I think the probability of that has been increasing as week by week.
We'll have more with Bob Hoye right after the break.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Aben Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Aben's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at abenresources.com.
Welcome back. We're speaking with Bob Hoye. Bob, there are rumors that former Bank of Canada head Mark Carney, who's now the chair of the Bank of England, could move to take the job of or vacancy at the International Monetary Fund that Christine Lagarde is leaving to become the head of the European Central Bank. Would that change any policies if Mark's in charge?
No. They both believe that central banks are omniscient, meaning know everything, and omnipotent, meaning have all the power. But let's go back to the theory behind the formation of the Federal Reserve. And at the time, authorities and big bankers in New York were concerned about, you had some whipsaw markets, 1903 and 1907, and there's always this urge that you can, if you think of, oh, this is awful, now there must be an agent that could prevent these sharp contractions, and they've been thinking that up since the crash of 1618. So anyways, the thinking behind the Federal Reserve was that it would be a bank with special powers because it was the bank of bankers. And let's use the term, supernatural powers have been assumed the Fed would have. And so the theory was that they then, in the early 1900s, knew that recessions followed sharp financial setbacks. So the theory is the Fed, with being lender of last resort, would prevent financial setbacks, and then that would prevent recessions. Well, it's a admirable theory, but it doesn't work. Since the Fed opened its doors for business in January 1914, there's been 18 recessions. So anybody with a physics background would look at it and say, here's the theory, here's the result. Doesn't work. So I wouldn't expect then you have these both personalities, Legrand and Carney, are attractive figures in their positions, the executive positions they've had, and they can talk the lingo, but they're still the public figure. And the public figure has to say what public figures say. And they really believe that their interventions would do well. And, of course, Mark Carney had been governor at the Bank of Canada before going to the Bank of England. But he completely jeopardizes his position as a central banker by commenting on global warming. And he really is a warmist and figures there's some sort of threat there. So it's fascinating, but both position changes would not influence financial history at all. And as we note, this financial history has clocked an outstanding boom and is now precarious. So, as I mentioned, one of the items that would provide the alert is probably due after August, which would be credit spreads extending, the widening, and the yield curve doing what it does. And then the other thing to watch on this, Jim, is our industrial commodities, which were expected to rally out into the second quarter, and base metals did, and they're churning around. Crude oil had a very good rally, and it's been churning around. And then you have seasonal lows for these items. Lumber is another one that has a seasonal high at around June. And then lumber, let's stay with that one, it can have a seasonal low in October. The crash in lumber from last year has been huge, and making precarious conditions for lumber producers in British Columbia. I read an article about that the other day. So fate says that lumber may have a low in October seasonally. Seasonal fates also say the same for copper. That one typically can be in November, December. And then crude oil, typically December, January. And so, and we also know that, well, I've called these items, the curve, the spreads, industrial commodities, as our friends of the rally. And they were likely to be good into the second quarter. And now they're beginning to change. And now they're likely to be bad once the change is completed down into near the end of the year. So it's kind of like reading a script, isn't it, Jim?
We'll have more with Bob Hoye right after the break.
I'm Douglas Mason, CEO of Naturally Splendid, symbol NSP on the TSX Venture Exchange. Naturally Splendid is a biotechnology and consumer products company focused on the global cannabis and health markets. Naturally Splendid is expanding distribution in this rapidly growing market with products currently in Canada, the USA, South Korea, Germany, and Australia. To view our comprehensive company presentation and for more information, please visit our website at naturallysplendid.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Bob Hoye. Bob, is it possible to have a hot stock market and a poor economy, or a poor economy and a hot stock market?
Oh, that's a good one. Yeah, Jim, that really is a good one, because in your regular bull and bear markets, which prevailed through the 50s, 60s, 70s, the stock market would set a peak, distinct peak, a cyclical peak, and that would typically be 10 to 12 months before the peak in the economy, as measured by GDP. So that has been reliable enough that the economic wizards have put the stock market, I think it's the S&P, into their index of leading economic indicators. So this then really gets to your question, because at the bottom, the stock market would also turn up before the economy. So you really only have then, in those old days, a happy instant when the economy was going up and the stock market was going up. Let's call that the middle position. And then you'd get to the peak in the stock market. It would roll over and head down. But investors and brokers and research departments would all be talking about how wonderful the economy is, while the stock market was going down. So then you had this disharmony. So then finally the decline in the stock and the economy rolls over, 11 or 12 months after the stock market. Then fundamental investors then would have, now I can sell because the economy is going down. So they would stay long while the stock market was going down. and then get out when the stock market was down further, but then the economy was going down. And then you get to the bottom, whereby then the stock market would turn up while the economy continued down. Maybe 6, 7, 8 months was the typical lead on that one. So then savvy traders would be buying a bottoming stock market because the technicals were good, but the big investors would not be buying a bottoming stock market because the economic numbers were bad. So this was wonderful for those of us who are doing research and trading. But then what happens, Jim, is when you're in a financial bubble, financial new era, when all kinds of recklessness is practiced, the speculation in financial assets is so huge that what has happened is that the stock market peaks on a bubble, and so does the economy, virtually together. So there's no lead from the stock market. And there's evidence of that in the U.S., where the NBER, the National Bureau of Economic Research, which is the body that formally determines recessions and booms. And so they've tracked recessions and expansions back to, I think, 1860. So they were there. They did the numbers for 1873. So the stock market in New York peaked in that September, and the economy peaked in that October. So virtually the same month. Then you move ahead to 1929, and the New York market peaked in September, and GDP peaked in that fateful August. So, within a month. And then in 2007, which was a very good stock bull market, and it had some of the characteristics of a great financial bubble, because the stock market peaked in the middle of October 2007, and the economy peaked in that December, very tight, not the usual 10 to 12 month lead. So it's my guess in here now, because this is now even a more super bubble than in 2007, that somewhere when the dust settles, it will be seen that the economy peaked very close to the top of the stock market. So this is, it's more than an academic, well, it is an academic exercise to watch the layover of previous bubbles upon recent bubbles, and the matchup has been pretty good. So this is sort of conjectural now, as you got the S&P, the Dow setting new highs, but the broader stock index, the New York Stock Exchange Composite, is not, and the world stock index that doesn't have U.S. in it is not making new highs. So, as a matter of fact, the New York Stock Exchange Composite and the World Index set their highs in January 2018 and has not made new highs yet. So, I think the next few months are, as we say, are going to be very interesting.
And Bob, sad times for us Mad Magazine fans. They're only going to publish original material once a year now. In essence, they're dead. And we both have our favorite moments. My favorite cartoon was one where a high school kid says, "Mr. Smith, could I borrow your $60,000 Corvette for prom?" And Mr. Smith says, "Well, Billy, how would you like to go to prom in a $500,000 vehicle?" And he gives him a ticket to public transit.
Oh, that's a good one.
And Mort Drucker was my favorite cartoonist.
Yeah.
Your favorite Mad
Drucker,
Magazine
yeah.
moment.
Mort was good. No, I go back to when I was at university and with the Mad Magazine, and it was really quite, you had this feeling of being very revolutionary, very avant-garde to have a copy of Mad Magazine under your arm. And a couple of years ago, I was talking to my daughter and complaining about socialism, and I said, "My God, it's creeping meatballism." And she said, "Well, Dad, what's that one about?" And I explained that I had to look it up, back in 1957, Mad Magazine, a writer by the name of Shepard, wrote about creeping meatballism, an essay, and you can actually Google it. But I sort of took it as being the retreat from responsibility, accountability, realism, that sort of stuff, into today's world of liberalism and socialism and all sorts of fantasies. And so my question, I sent it to a few guys I know of my vintage that would have been Mad Magazine readers, and I said, perhaps it's creeping meatballism that's taking down Mad Magazine. And then they had one of their favorite sayings was "Verschlagener." So that's what I put in as well. And then I looked it up, and I think "Verschlagener" is kind of a Yiddish word for, good grief kind of thing. So anyways, we old-timers will miss Mad Magazine, and the covers with Alfred E. Newman on it. What? Me worry? So I guess, hey, Jim, we're going to have less worries now. No, wouldn't we go the other way? Maybe we're going to get more worries.
More
but
worries
anyways,
now, yeah.
Sad to see Mad Magazine heading out, exit left.
Bob, thank you so much for chatting with us.
Yeah, we'll be back again next week.
What? Me worry?
My
guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. If you have any questions for Bob, you can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.